Other than your education, your two main expenditures throughout your life are likely to be housing and transportation. There are a number of factors to consider in terms of both where you'll live and how you'll get around. And while some of those factors are driven by your personal preferences or lifestyle, others are dictated by your financial situation, and then in turn can have a substantial impact on your finances going forward. In this part of the lesson, we'll discuss some key considerations around housing options. When you think about housing, the first major decision you may have to make is whether you want to own your own property or whether you'll be better served by renting or leasing a property, either on your own or as a cooperative arrangement with friends or family members. There are pros and cons to each. Home ownership has long been referred to as the American dream, and for many people it symbolizes stability and financial security. Though the housing market may wax and wane, many Americans believe that it is financially beneficial to buy a home at the earliest opportunity, whether it be a single-family home, a duplex, or condominium, and that over time it will grow or appreciate in value, meaning several years from now your home will be worth more than it was worth when you initially bought it. Now, most of us are not able to buy a home outright by paying cash. It is a substantial financial transaction, and most people need to take out a mortgage loan to pay for a large part of the purchase price. We touched on mortgages in the lesson on credit management, and should you decide to buy a home, your mortgage is likely to be your single largest loan, and repaying it is likely to be your largest monthly expense. We'll learn some mortgage terminology in this lesson, but it's key to understand now that equity is something you build when it's worth more than what you paid or what you owe for it. For example, if you owe $100,000 on your mortgage and your home is estimated to be worth $150,000, you would be said to have $50,000 in equity, the difference between what you owe and what you could reasonably expect to sell the property for. Owning a home gives you an opportunity, though not a guarantee, to build equity. Homes tend to rise in value over the long term, while at the same time your monthly payments are reducing the amount owed, which will over time allow you to build that equity. Owning a home may confer tax benefits as well. Because you're generally paying property taxes and other fees, you may be eligible for certain tax deductions or credits that are not available to renters. Having said that, you do have to pay property tax and insurance. These are often rolled into your mortgage payment, but they can be a substantial expense. When you rent an apartment, of course your rent is likely also covering the property tax that the owner must pay, but you're not paying it all directly yourself, and your insurance is likely going to be less. Owning a home is generally a longer-term commitment. You can certainly buy and sell homes as often as you like, or at least as often as the housing market in your area will allow, but it can take time and money to buy and sell homes. There are a number of fees involved, and most people buy a home with the intention of staying in it for at least several years. This can mean that you have less flexibility if your circumstances change. If you take a new job that's much further from your home, you may be more easily able to end or terminate a lease and get a new apartment than you could sell your home if you needed to move. Credit requirements are higher to buy a home. While nearly every prospective landlord would check your credit before renting you an apartment, a mortgage loan provider will conduct a much more stringent credit check as they expect that their relationship with you and your obligation to pay your debt faithfully and consistently will be a much longer-term situation that warrants additional scrutiny. Finally, when you own a home, upkeep and maintenance are all your responsibility. If the air conditioning unit breaks, the furnace dies, or the roof develops a gaping hole, you are responsible for fixing it, and you run the risk of devaluing your own investment in the home if you don't do so in a timely fashion. Being a homeowner means you need to be even more diligent about building and maintaining an emergency fund to cover these types of expenses. While home ownership has its pros and cons, so does renting or leasing. For this lesson, you may consider renting or leasing to be any housing for which you pay each month but do not gain ownership in the property. It may be an apartment, a home you've rented, paying for a room or other portion of a larger home, or contributing to a family home via a monthly payment. Leasing simply means that you've signed an agreement to rent the home or apartment for a specified period of time. In some cases, you may be able to rent housing month to month, meaning you live there for as long as you need to and simply give notice to the owner when you're ready to move. But most rental properties will require you to sign a lease for a specified period of time, generally 6 months to a year. Even with a lease, renting a home may give you more flexibility. If you want a 2-bedroom home now and are sharing with a friend, but he or she moves to take a job, you may decide you want a smaller home and to live alone. At the end of a lease, you could move, but if you own a home, you would have to consider whether it made sense to sell. Likewise, if your income changes, renting would give you the option to spend more or less on a home without needing to list, sell, and buy another property. With an apartment, you also don't need to worry about upkeep. The owner of the property is responsible for repairs and maintenance on the property and things included with it, such as the furnace and appliances. However, in a rental home, you do not have the chance to build equity. There would never come a point at which you owned your home outright, or it was worth more to you to sell than you were paying for it each month. In addition, there may be other restrictions, such as the number and types of pets, if any, that you're allowed to keep, or how you can decorate or utilize the space that you're renting. When you consider your housing choices, you'll want to weigh several key factors. Of course, there's whether you want to rent or buy, and that's a major factor, but it may also be influenced by other things as well. Cost is a major consideration for most of us when we think about where we will live and what type of housing we will look for. For example, you may want to move to a town where housing is much more affordable. That may influence your decision to consider buying rather than renting. But even within your current area, housing may be available at many different price points, and you need to decide what is affordable for you. As we learned in the lesson on personal budgeting, there are several ways to approach this. If you use the 50-30-20 budgeting approach, with 50% of your income being allocated to your needs, then you will want to include housing as part of that 50%. Another recommendation we looked at in that lesson was for those on a tight budget to allocate 35% of their spending to housing. So those are two guidelines you might consider relative to your own income situation. For example, if you don't need to pay for transportation, you may be able to allocate more of your money to housing. Location is key. You may find that living a bit further from your work or school allows you to find more affordable housing options, but that may also increase your time spent commuting or your transportation budget. Value is another key factor. Something may be more expensive, but if it includes utilities or other features or services you need, or the location is ideal for you and your household, it may be more valuable to you, even if the price is a bit higher. Nearby amenities are also important to look at. Once you know what you can afford, think about what you will need or want to have nearby if possible. For example, if you have kids, what are the nearby schools like? Are there grocery stores close by? If you like to spend time outdoors, are there parks or other outdoor activities close to the home? Finally, your lifestyle preference and personal priorities must come into play. If, for example, you prefer a carefree lifestyle and your priority is free time and an easy commute, you may prefer to spend your money on an apartment closer to your work. If your priority is investing money for the long term and living more affordably, you might prefer to buy a small home a bit further from work if that can save you money. Of course, as you learned in the credit lesson, your own credit history and score will be an important factor in your ability to carry out whatever decision you make and get the kind of housing that you want. Now we'll cover some key terminology. When you buy a home, there's a lot to learn, but here are the major concepts and terms you'll need to know. A mortgage is the loan you have on a home. You qualify based on your credit history and score for a mortgage, and then you make the monthly payments to the mortgage holder or servicer until the loan is paid off, at which time you own your home completely. The interest rate, as you'll recall, is what you'll pay for the privilege of borrowing the money. The mortgage holder has paid the seller of your home in full, and you are then paying the mortgage back over the course of probably 15 to 30 years. So that mortgage holder needs to make some money for the time that you have their funds and are paying them back. A down payment is the amount of money you put down from your savings when you buy a house. 20% down payment is a great goal, meaning that for a $100,000 home, you would pay $20,000 in cash or check and then mortgage or finance the remaining $80,000. While some loans allow you to make a much smaller down payment, the more you have to put down, the more loans you're likely to qualify for, meaning you'll be able to choose one with a better interest rate and terms. Property taxes are charged in nearly every town, city, or county and are an annual amount based on the value of the property and paid by the homeowner. If you have a $300,000 home, you're likely to pay twice as much in property tax as someone who lives next door to you and whose home is valued at $150,000. Property taxes can be used by local governments for a variety of purposes, but one very common use is to fund local school districts. So towns or cities with higher property taxes often have more desirable schools because they are well funded, which in turn attracts families with school-aged children to live there and can help to increase home values, even for those without kids in school. Finally, escrow is an account that holds money. When you buy a home using a mortgage, the mortgage holder has a financial interest in making sure that the home is protected from loss or damage. So they require you to maintain certain levels of property insurance and to pay your property taxes. They usually do this by including the amounts, or the best estimate they have for those amounts, into your monthly payment. So if your property taxes are $3,000 a year and are due every year at the end of December, your mortgage payment will include $250 a month that goes into an escrow account and is held there. And the mortgage company then pays the property taxes from that account at the due date. They do the same with your homeowner's insurance. This helps them to know that if the home burns down, for example, they'll be protected from loss because they're certain the insurance was paid. Once you pay off a mortgage, you still have to pay insurance and property taxes, but you generally do it on your own. And so then you need to factor that amount into your budget so you'll have a sufficient lump sum available at the due dates. Now we'll cover some key terminology you may hear when you're renting a home or apartment. The first thing to understand is the lease. As mentioned earlier, some properties may offer a month-to-month option, but most are likely to require some sort of lease. The lease is an important legal document, and when you sign it, it's vital that you understand the terms in it and keep a copy. The lease will refer to the property owner or management company as the lessor, and to you, the resident, as the lessee. The lease will spell out how much your rent is, when it is due and how it must be paid, what the consequences are if you are late or fail to pay it, and a host of other details that spell out the responsibilities of all parties, including things like how to report needed repairs and how soon the lessor is required to respond and make those repairs. Some of the terms of a lease may be governed by state or local law, and if you have a dispute with your landlord, you'll want to consult both your lease and any applicable legal entities. The security deposit is an amount you're usually required to pay when you move into a rental property. It's common for a lessor to require you to provide at least 1 month of rent, sometimes 2, plus a security deposit that protects them against any possible damage you might do to the property. This is sometimes referred to as first month, last month, and deposit. While this can be a major outlay when you're moving into a place, it, along with a credit check, helps the lessor be sure that you can truly afford the property. There may be an additional pet deposit if your rental home allows pets. If you leave the home in good condition at the end of your lease, you'll likely receive most or all of your deposit back. If you do damage the property beyond what is considered normal wear and tear, you will likely forfeit some or all of your deposit and may even be held liable beyond that via a lawsuit. For example, if you live in a home for 2 years, it's normal wear and tear that the carpet may be dirty or the walls may have a few minor scuffs. But if you leave a burnt patch in the carpet and a hole in the wall, these are considered tenant damages and your lessor will hold you financially responsible. Your lease may include restrictions on activities, such as whether or not you can have pets, or parties, or multiple house guests, or long-term house guests. You may also be restricted in where you can, say, store a bicycle on the property, or barbecue on a grill. It's important that you know what the rules are, so you aren't in violation of your lease agreement. Finally, amenities are the extras you may see advertised with a rental listing. These could include a pool or volleyball court in an apartment complex or snow removal in a townhome development. They are things designed to enhance the quality of life in a rental property.